Hello viewers, my name is Lalit Abichandani and I'm owner of Epic CPA Associates in New York City. Our episode today is about financial planning, and Paresh Ji, who is an expert in this topic, he will educate us and give us details about financial planning. Paresh Shah is the CEO of Paresh Shah Financial Services. He's a certified financial planner, and for the past 17 years he's been helping individuals as well as businesses in co-creating the innovative financial strategies. He's a licensed CPE presenter, educating CPAs as they guide their clients on investments, life, disability, and long-term insurance. He specializes in pension and profit sharing plans, asset protection, estate planning, and business succession planning. Paresh graduated as chemical engineer from IIT Kharagpur in India. His strong sense of professionalism and community service has kept him active in India as well as in US. He supports healthcare and education initiatives for financially challenged. So, Paresh ji, we are seeing a retirement crisis in US. As a CPA, I have had clients come to me and say they are not confident about having adequate income in retirement. Most of them had to do two jobs. Can you address what's gone wrong in this country?
First of all, thank you, Lalit, for the lovely introduction. Really appreciate that. And I totally agree with you that we have a crisis on our hand. For a lot of Americans, traditional financial planning has failed them completely. And I'm not here talking about those people who are not saving enough money or those who are spending a lot in keeping up with the Joneses. Here I'm talking about the average hardworking American who saves money, puts it aside for their retirement, and is hoping to live a life of dignity and independence in their retirement. The traditional financial planning world has, in a way, failed these Americans, and that has resulted in this crisis that is happening out there.
Paresh ji, you said traditional financial planning has failed. What is traditional planning in your opinion?
Lalit ji, what I'm about to say is not necessarily the case with everyone. However, it is the general opinion that is observed out there. And traditional financial planning, what it would mean is that you work, you save money, you put it into a portfolio of stocks and bonds, then you expect it to get an optimal rate of return and it will grow over a period of time. Now, once you hit the point of retirement, then what's going to happen is that money that you've accumulated in all these years, you would put that away in some kind of secure investment, because in retirement we do not know whether we are going to live 1 year, 10 years, 15 years or 20 years. So you put it away into a secure investment, and you only utilize the income out of that. So that is what I see as traditional planning. And what I have observed is, and I'd like to give an example of what could have caused failure. So there was this one couple whom I had met, and they had about $1 million of retirement savings in the year 2000. And what they had decided to do was put that money away in a bank on interest. In the year 2000, they were getting about 5% very secure returns from the bank. So they have 5%, that is about $50,000 of income coming in. Along with their social security and the fact that they did not have any other liabilities like they had their house which was paid up, etc. This money was adequate for them. But come the year 2007, this particular interest rate had fallen from a high of 5%, had gone down to less than 2%. Now, they did not have adequate money because $20,000 was not enough for them. So the traditional model in which you expected that the secure institutions, Lalitji, are going to take care of you in terms of income, those are no longer available. And that's what I meant when I said that if you just followed that one traditional model, you would have seen failure. I'm not even taken into account here inflation. That means the prices going up from 2000 to 2007. All I'm talking about here is that the basic income available has gone down.
Absolutely. I've seen the interest rates are now about 1%, and I've seen that happening to some of my clients. What you have said has raised several questions in my mind. To start with inflation. So tell me about that. What effect does that put on financial planning from your perspective?
Lalitji, I like to call inflation as the silent tax. And let me ask you one question. You in 1985, what was the cost of a first class postage stamp?
I think it was somewhere 22 cents at that time.
Exactly.
Yeah.
You're absolutely correct about that. It was around 22 cents. And now today, in 2016, the cost of a first class postage stamp is 49 cents. So over a period of 30 to 31 years, we have seen the basic cost of things go up about 2.2 times. Now let us see how that translates into somebody who is working towards their retirement. That means if they had retired in the year 1985 and they needed say 5,000 a month to manage their regular expenses, that means about $60,000 a year. Today they would need at least about $132,000 to $135,000 per year. So there is a twin effect that has happened simultaneously. On one hand, their expenses that they have needed have gone up, and on the other hand, the income has come down because in 1985, a 5-year CD from any major bank would give you 10% interest rate. And today we are getting, as you rightly pointed out, 1% interest rate. So if the incomes have come down and the costs have gone up. Now this is just one aspect of inflation, Lalitji. To take it a step further, there are some areas of our daily expenses where the cost of living is going up much faster. Like if you look at college education or if you look at healthcare, there the increases have been much more than what have been the increases in the cost of say food and travel and those kind of things. So why is that relevant? Because when we're talking about planning for retirement, we know that as we get older, healthcare costs are going to go up. So not only have people's income gone down, basic cost of living has gone up, and for seniors the requirement is more than that 132,000 because healthcare costs have gone up a lot more. So here this scenario has really created a very, very difficult situation for our seniors. And when people see that scenario for other people, that means that people struggling with what they have, they are worried about their own retirement. So that's what I see, Lalitji.
Okay, but what about the other alternates like stocks? I mean, the stock market keeps going up. If I've heard that if you have a good portfolio of stocks or even bonds, that can help overcome the challenges of the reduced interest rates and the inflation. What's your thought on that?
Lalitji, that is a very fair point, and I'm going to divide this into two parts because in the first part, Lalitji, we are talking about people who have very large amount of wealth. So let's say somebody has, and I'm just throwing a number, say somebody has $5 million of investable assets and he needs $100,000 or $150,000 of income. For them to invest in a stock bond portfolio that goes up and down, that varies in income, is fairly okay. But somebody who is got lesser amount of money, the average person who has lesser savings, and that person is looking to invest in stocks and bonds to try to get a fair, decent return which they can take off the top and use every year. That is where the real challenge lies. I'll give you one example. In about mid-90s, there was a study done by 3 professors of Trinity College. It was called the Trinity Study. And they really did a very, very detailed analysis. I mean, it was absolutely a gem of an analysis, in which what they found out was that they took studies from straight 1925 going up to 1995, and in between they took 30-year spans, They said if you invested in stocks and bonds and you withdrew 3 or 4% of your initial amount, so if you had $1 million, you invested either 30,000 or 40,000, you took 30,000 or 40,000 dollars as withdrawal every year, you can say that in 30 years you will not run out of money. That was a good, well-established theory, and it looked very nice and it looked doable. But then this theory was re-examined after the 2 crashes in the stock market that took place in the year 2000 and then again in the year 2007. And now when we look at both these crashes, after that we find that if you are withdrawing 4%, there is a possibility that you might run out of money in retirement. So now, Lalitji, you see this difficult situation that our seniors are facing. One end there are theories, they put them into motion based on those theories, and then afterward they come upon a point when suddenly they are running out of money. And that becomes a very, very difficult and dangerous situation for our seniors, so for the people who are retiring.
So Pareshji, most people get Social Security. How can people plan so that they can be confident about their retirement in addition to whatever they get in Social Security? Are there any plans that you can suggest?
Right. Let me start with a small disclaimer, Lalitji. First of all, every plan that we need to make is tailor-made. That means it's not that I can give a general recommendation that all of this is applicable to everybody. But there are some norms and rules which if you can follow, then you should be able to supplement income adequately to add to the Social Security income that you just mentioned about. Social Security is also a challenge, so these days we do not depend upon Social Security because of all that is happening in the government. Absolutely. But at the same time we say, okay, there is a certain amount of income that you will get from Social Security, and then on top of it, how can we plan better? And the good part is that there are planning techniques today which we can use for everyone who wants to start today to plan for the future. So it's like if you are looking at other people's situation and wondering what you should do today, then there is hope and there is ways in which we can do it. Now the methodology that we have adopted over the last several years is based on a very central concept. Lalitji, you and all of us, we are professionals practicing. So a person who just steps out of college, all the income that he is going to make over the years, that is his biggest wealth. That is the 30-40 years of income that he is going to make. So he's going to work and he's going to exchange that for currency. We call that human life value. So investing in human life value and then protecting human life value, that should be the first thing that a person should do. That means how do I protect human life value? That means in case that there are some challenges and I'm not able to work, then I should get adequate income, and at the same time I should be able to develop adequate wealth. So that is the first thing we talk about. In any planning, the foundation stone should be protection. The second stage of planning needs to be saving, and saving would mean that we would like to have enough money so that we are sufficient with the money that we have for the income. The third stage would be that there should be growth. And that means that once we have got enough savings, which will give us guaranteed income in retirement, then we should look at the second part, which is trying to save money for growth purposes and for vehicles that can go up and down, or the risk-based investment. Lalitji, what we offer to everybody is to sit down with them and give them a consult so that they can design a plan around protection, savings and growth, and we'll be happy to talk about that with anybody. Now Lalitji, I want to just say one more thing before I hand it back to you. I've given a very superficial answer, and this is a very complicated topic, so we will take this up in details in further episodes.
So what you're saying is financial planning is a must, and these details are very important. Viewers, it's very important to plan early in life so that you can take care of the advantages it offers you. That's it for today. Thank you very much for watching us. We'll see you in 2 weeks. And in 2 weeks, our next topic is going to be about gift giving and inheritances and death taxes. So see you then.